Mode.
Good afternoon. Welcome to our webinar on What's It Really Worth? A real-world look at valuing your business for sale. I'm Amy Longmore, and I will be introducing your presenter today, Roy Johnson. Roy has over 40 years of experience encompassing corporate financial management, business consulting, entrepreneurship, education, investment banking, and mergers and acquisitions. Roy was the Director of Corporate Financial Planning for a Fortune 1000 company, the co-founder of 2 value-based strategy consulting firms, a principal in a management buyout, and the author of several articles and books on shareholder value. Please type any questions you may have during the webinar in the chat box to the right-hand side of your screen, and we will address them at the end of the webinar. There will be a brief Q&A session after any questions presented have been answered. We hope you enjoy the webinar. Roy, are you ready to begin?
I am, and thank you very much, Amy. Today we're going to try to give you a real-world look beyond financial theory as to what is really going on in the world of private company transactions when it comes time to do a transaction, whether that be an internal sale or an external sale. So to start out with, I'd like to just go over the 4 main objectives that we have for today's session. First, we want to try to give you an understanding of the different standards that are used in valuing different types of businesses. And then we'll get into what we think is a real-world formula that buyers use. And one of the important things for any of you business owners is to be able to put yourself in the shoes of the person or company that may be looking to buy your business. So we're going to try to get you into their heads and give you a little indication of how they think. Then we'll spend a little bit of time talking about the difference between value and price. They're very similar, but there are some differences there. We'll go into that. And then we'll conclude by discussing 3 key principles of maximizing or at least optimizing the price paid for business, which is obviously the price that you as a business owner would receive. So those are going to be our objectives over the next 30 minutes. So I want to start out by looking at the different value standards. There are 3 major ones, and the first one, which usually produces the lowest valuation, is called liquidation value. This is typically used for unprofitable businesses, and then there are certain industries such as construction which seem to fall into this category due to some reasons we'll discuss in a moment. And this type of valuation is essentially based on the asset or the book value, or as we note here, the asset saleability. So this is not what we would call a going concern, but more of a situation where the value of the business is kind of related to the assets that are on the books. The second major one, and the one that is used very much in many kinds of transactions, is called fair market value. This is used in internal buy-sell agreements that owners may construct amongst or between themselves, employee stock ownership plans or ESOPs, and then estate and gift tax type situations. This fair market value standard is based on the financial statements and a forecast. You are allowed to forecast the future, assuming it's reasonable when you're doing fair market valuations. And as we'll discuss in a moment here, some of these fair market analyses are subject to governmental and IRS regulations. The last one, which is what most business owners are certainly striving for, is what we call strategic or synergistic value. And this is really the market value of a business, reflecting opportunities that exist out there for the business. Now, some people kind of lump strategic and synergistic values together. We like to separate those. So when we look at a situation, we look at a synergistic situation as related to cost savings and efficiency, and strategic value more related to growth. It's a subtle distinction, but we think it's a fairly important one. And this is all based on buyer perception. This goes beyond the financials, and it's not always easy to predict, what could be the market value. And here we get into a little bit of a comparison to a public company, and its valuation in the public stock markets. So let's talk about fair market value for a moment. This is defined in IRS ruling 59-60, which you may have heard about. It assumes that there's a hypothetical buyer and seller, neither of whom are under any compulsion to buy or sell. There's an adequate knowledge of the key facts and figures involved in the transaction, and there is no allowance for any kind of synergies or strategic advantages. It's basically based on the the books and records of cash flows of the company. It also assumes an all-cash sale with no financing involved. Now, the fair market value is required for a gift and estate tax filing, plus an ESOP, and that is on IRS regulations. So you must do it if you're filing a gift and estate tax filing, or if you're doing an ESOP. And it's usually most suitable for a buy-sell agreement and a management buyout. Some of the key features is that we assume an anonymous prospective purchaser who is prudent, and again, as I mentioned, who is not going to gain any strategic or synergistic benefits from buying the company. It assumes an all-cash sale without any seller financing, earn-outs, restrictive covenants, and so on and so forth. And it doesn't really get into things like customer concentration, depth of management, things like recurring revenue and gross margins, which are sometimes very important to a more strategic type of a buyer. So that kind of sets the stage for the fair market value standard, when it's used, how it's used, and some of the key features of it. When we get into the market value, going beyond what's on the books and records of the company, and we get into synergistic and strategic considerations, there's really two key features, and this applies in almost any private company business sale, particularly to another company. The first concept, or the first factor, is what we call the most probable space. And then the second concept is a range of values, because different people will see the same business in a different light. So unlike the stock market, which has a very specific price, every day of the week it's reported in all the major business journals and online now, obviously. Private business tend to work more off a range of values. So that price for the assets, or the stock that's intended for sale, and that is a representation of what we call the total consideration that's most likely to be established between a buyer and a seller. So now, unlike the fair market value, we have compulsion on either one or both of the parties. Compulsion when we sell a business, hopefully on the part of a buyer, to be seriously interested in the business. But a seller could also have some compulsion too, which might influence what he's or she is willing to sell the business for. Age, lifestyle, considerations, health, some of these issues could be a consideration on the seller. Usually on the buyer side, it's a business that they really like, and they see it as a very good add-on to what they already have. And the second major consideration are all these benefits that we'll go into in a moment, the synergistic, strategic, and then potentially other non-financial benefits that could accrue either to the buyer or the seller. So the purpose of the most probable selling price, MPSP, is really for businesses marketed for sale. And just to kind of repeat myself a little bit, it's not appropriate for gifts and estates, divorces, buy-sell agreements, and fairness opinion. These really fall within the purview of fair market value. Okay, so now let's talk about some of the approaches and methods for estimating value. And we got three major ones, and bear with me here. At my age, this is the closest I can come to, bouncing a basketball, which is a game that I sincerely love, but unfortunately can't play it anymore. So we've got three approaches for estimating values: the asset approach, the income approach, and the market approach. And under these are various methods for calculation, which we'll go into now. So when we look at the asset approach, there are two major methods that are typically employed. One is an orderly liquidation. So a business is put up for sale. It may not be doing very well. It may not be able to get a going concern value, but at least it's not going totally into the tubes, and you can have an orderly liquidation. The other situation is kind of a distress situation, and then there may be a fire sale of the assets. Could be a serious bankruptcy, Chapter 7 kind of liquidation, that kind of thing. And sometimes when those situations exist, you will literally have a fire sale, and you try to get as many cents on the dollar for the assets as you can. The income approach is probably the most well-known. Under this type of approach, we employ a method called discounted cash flow analysis. And this incorporates both the existing and, if the business has some growth potential, the expected profits, down the road a piece, and then along with a risk factor that's appropriate for the business. So this is basically a situation where either the current level of cash flows are kind of capitalized and assumed to continue literally indefinitely out into the future, or where there may be a forecast over the next 2, 3, 4, 5 years, let's say, and there's an expectation that the profits will grow. I mean, hopefully they're not going to decrease, but so either one of these is going to involve an analysis that basically employs a discounted cash flow methodology. The market approach is a little bit similar to looking at the real estate market, where you do comps. And here we get into a comparison of your particular business to transactions of businesses that are similar or comparable. And as I mentioned, it's simpler to doing a real estate comp. We have some data sources that we use which accumulate information on private company transactions. We actually contribute to these every time we sell a business. We contribute, on a non-name basis, the key factors in there. So there's a pretty good body of evidence that we have on most of our deals that gives us an idea of how your business will be compared to another in terms of multiples of sales and earnings and those kind of things. Okay, so now let's get into the real world, and let's see how we take what we've talked about up to now and put it in the context of a valuation formula that you're going to be dealing with should you get involved in a transaction at some point in time. And the formula is that the most probable selling price, or the market value, is going to be the EBITDA, which is going to be adjusted, and we'll go into that in a moment, times an industry multiple, which will give us kind of a fair market value. And then added to that will be any synergistic or strategic value that the buyer sees. So this is the formula that's typically used. And just to give you a very simplistic example on a company that is selling, or either sold or expected to sell, for $6.5 million. So we'll assume that the EBITDA for this business is $1 million. And we will assume that the multiple, the EBITDA multiple that's appropriate for this particular type of business is 5, okay? So if we take $1 million times a multiple of 5, we obviously get $5 million. So that would be the fair market value without any growth or cost-saving opportunities. If in our example, we're going to assume that our buyer has 2 opportunities. They see some strategic value for growth opportunities of $1 million, and they see a $500,000 potential for cost savings through efficiencies or things that are duplicative of what they have. And so when they add these together, they come up with $6.5 million. So in a very simplistic sense, this really illustrates how these valuations are done. Now, obviously, there's a lot of detail, a lot of analysis that goes into getting these numbers. But at the end of the day, conceptually, these are the kind of things that you really need to know in terms of how a buyer is potentially going to look at your company. So as I mentioned, when we get into the whole market value issue, or even fair market value, we deal with something called adjusted EBITDA. EBITDA being earnings before interest, taxes, depreciation, and or amortization. So EBITDA is basically the pre-tax cash flow of the business. I think most of you know that depreciation and amortization are basically bookkeeping expenses. They're related to equipment or furniture or machinery or building expenditures that you may have made, and you are allowed to depreciate those over time. If you've bought a company and have taken on some goodwill, you're allowed to amortize that over time. You know, and there are all sorts of SEC and GAAP rules and regulations for how that's determined. So EBIT is the operating income, EBIT, and then to that we add the D, which is depreciation, and then the A, which is the amortization, and that gives us the pre-tax cash flow of the business. And we're looking to do that on an adjusted basis. So we start out with the net income, and then we add back the interest and the depreciation, because interest is a financing charge. As we mentioned, depreciation and amortization are these bookkeeping entries. Then we typically look at the owner in terms of the salary and benefits that he or she is taking out. Here we get into, you know, both the salary and things like auto expenses, pension, you know, personal travel. Some owners have life and health insurance that's unique to them. The second major adjustment gets into unnecessary or discretionary expenses. Some of you may have a spouse on the payroll. You know, you make donations. If you own the property, you may have excess rent, you know, that sort of thing. And then the third major area, what we call non-recurring expenses. If you did a capital expenditure for the roof or the parking lot, or had some one-time write-offs, those kind of things. Those are typically excluded. But then we would add back, if appropriate, a general manager's salary to run the business, and that really depends on the situation. Some business sales may require, you know, a new general manager to come in. Other situations, the buyer might have somebody to run the business. So that's kind of an area that, if it's appropriate, we do that. So this gets you through the major adjustments we make to the books and records of the company. In other words, what we adjust to the reported results. Okay, now we want to talk about the EBITDA and its multiple and explain what that is a little bit. So industry multiples are different, as we show here in red, and they're due to two main factors. The first one is growth, and the second one is risk. So those industries that typically have lower multiples, and again, I'm kind of typifying things here. They obviously could find some unique situations that might be different. But the construction and auto industries typically have low to moderate growth opportunities and often high risk. They're cyclical. And, you know, they can change from year to year. And buyers will discount or put a higher risk factor, you know, for those kind of businesses. Moderate multiples occur in industries like general manufacturing, distribution service, you know, those which often have moderate growth and risk. Things like refuse collection, where you'll have recurring revenue, and where the recurring revenue will offset the high investment and low growth. And then you may find higher multiples in areas like precision manufacturing, where the company has a significant amount of pricing flexibility due to the uniqueness of their product and the customer willing to pay for this very high-end type product. And then finally, in terms of some of the new industries that have come on stream recently, cellular service, internet software, and so forth, where you get into recurring revenue streams. Most of these businesses try to get a contractual type of recurring revenue. Many of them are characterized by high initial investment, but then as they move on and gain more customers, that delivery cost goes down as they add on additional customers, and then quite often these industries there's high growth potential. So again, just a kind of a quick look-see to give you just a little bit of flavor of how industry multiples are different and why. Then we want to get into the whole area of the industry multiple and why and how they're treated. So when a buyer perceives a risk, that is embedded into the industry multiple. And that includes things such as loss of customers or suppliers, the potential for decreased gross margins or increase in expenses, possibility of losing key people or some institutional knowledge, a new competitor coming on stream, loss of productivity, and then certainly last but certainly not least, economic or industry downturns. So when buyers look at industries, embedded into the multiple is their perception of these kinds of risks. And depending on how significant and how prevalent these risks are, that industry multiple will be higher or lower. And again, just to try to give you a little bit of flavor and explanation as to why industry multiples are different. Let's talk a little bit about synergistic value now, okay, the efficiency, expense cutting kinds of things. So in this context, the buyer sees an opportunity to eliminate duplicate, certain financial type functions or administrative functions might be eliminated. Optimizing supervisory and other overhead types of people. There may be eliminate occupancy expense if the operation could be moved into the buyer's facility. That could be eliminated. And reducing sales expense if there's some duplication there. And then, you know, perhaps achieving economies of scale for purchasing power and things of that nature that the buyer may have but the seller doesn't have just due to size. So these are some of the more important examples of how a buyer may see some synergistic opportunities. On the strategic side of it, again, you know, going back to our formula, looking at some of the key strategic opportunities here, these kinds of buyers, these strategic buyers have typically committed to a plan. They usually have put together a strategic plan, you know, which is why they're strategic, and they see the purchase of a particular company as furthering that course of action at a lower price than could otherwise achieve. By the time you will come across a strategic buyer, particularly a sophisticated one, they will have already done what we call a make versus buy analysis. So they will have probably looked at the opportunity of growing a business from scratch organically versus buying into a business. And the reason they would be out there looking at you is that they've made that analysis, they're committed to a course of action, and they have come to a determination that buying is more effective for them and will produce more value than trying to build a business from scratch. So some of the key factors here that a strategic buyer will be focusing in on is their perceived need to diversify their customer base or their product line. They may have a desire to integrate vertically. They may already have a distribution channel or manufacturing ability that they can leverage through buying your company. And they typically have a goal to increase their market share, and you, the seller, have some share in your geographic area that they want to capitalize on. We had a very successful transaction a year or so ago in which a company from the Midwest came in and bought a Northeastern-based company because they immediately got into all of the 6 New England states plus half of New York. And it would have taken them a lot of time and a lot of money to try to do that themselves, they would have had to compete with this company, so they basically bought them up and bingo, they got what they were looking for. So point being, you've got usually a very smart buyer here. They kind of know what they're doing. They know what they're out for. And if they see value, they will usually be willing to pay for it. Okay, one of the objectives that we said at the outset that we wanted to do is distinguish a little bit between price and value. So the key factor about price is that it is a fact, whether it's an asking price or a sold price. So price is a fact. Value, on the other hand, is an opinion. It's what somebody thinks they will get, for a business in the future. And we have these standard of values that we described earlier, and obviously these are the values that are provided under a particular set of condition, circumstances, and assumptions. So price is a fact, value is an opinion. And, that's all we want to say about this matter here. Okay, the next objective we had was to give you a little insight about maximizing the price that is paid for a business. And here we have three basic principles that have been out there almost since the day that, buyers started buying sellers. And the first principle is that different buyers will pay different prices for the same business. They just see it differently. One buyer may see a very little bit of opportunity. Another buyer may see a huge opportunity. Same business. It's just that based on where the buyer is, they will view the business differently. So different buyers will pay different prices for the same business. The second major principle is that the buyer who perceives the most opportunity will be in a position to pay the most for the business. Okay? And then comes the third one with a big but. But that buyer will never offer all the business is worth to him if he can buy it for less. That's just basic economic rationale. So these are the three principles that govern most private company sales. At Touchstone, we encounter this, virtually every one of our working days. So different buyers will pay different prices for the same business. The buyer who perceives the most opportunity will or should certainly be in a position to pay the most, but he'll never do it voluntarily. He's got to be forced into doing it. So how do we do that? So how do we get the best buyer to make his or her best offer? Well, the first thing we do is we market the business without a price. So unlike a Main Street type of transaction where a liquor or retail store may be for sale and the price is out there and that sort of thing, we do not market the business with a price because we don't know what it's worth, frankly, to a prospective buyer. Now, we will give the owner what we think is a realistic range of values before going to the marketplace to make sure that he may be comfortable with an offer, particularly if it's at the lowest end of our range. But when we market, we do not put a price on the business. We will try to place that buyer in competition with other synergistic and strategic buyers. So we're literally trying to create a public marketplace where none exists, and that's part of our role as M&A advisors. And then finally, and very importantly, we give the buyers one chance to make the offer. And we tell them this. You've got one bite at the apple. Make your best offer. Don't come back a week or two, with another one because the business will be worth exactly the same in 1 or 2 weeks as it was now. And so these three strategies on our part seem to work in the marketplace. Marketing the business without a price, placing these buyers in competition with each other, and then giving them just one chance to make their best offer. And that's basically the game plan that we employ when we go to market with a business. So that kind of wraps the formal comments here. Just a little bit about ourselves. We're a merger and acquisition firm. We're typically working with companies in the $3 to $50 million revenue range who are either seeking to sell their business in the near term or maybe wanting to plan for an exit if the sales is a longer term.
I can't hear Roy anymore. Thank you, Roy. I would like to take a moment to let everyone know that our next webinar is scheduled for October 13th at noon, as you see on the screen. Our topic, what is synergistic and strategic value and why should you care? You may register on our website at www.touchstoneadvisors.com or watch for an email invitation. We hope you will join us again, and this concludes our session for today. Thank you.